I believe you're going to find this a fascinating interview because, we talk to a lot of bullish people a lot. The bears have, they've gone into hibernation. Even the real bears, right, Lakshmi? They
Yes, they
hibernate for the
do.
winter. So
Yes, they
thanks
do.
for you waiting to go back into the cave to fill us in on what you do. And Laks Ganapathi is the CEO and founder of Unicus Research, and they specialize in putting out research for short ideas only. So, very interesting niche to pick. I'm interested, Lakshmi, what was the attraction to the financial markets? What motivated you to choose this career path and really to really be a specialist? Because it takes a certain type of mentality to be a bear and to be looking for opportunities of declining issues rather than everyone who's jumped on the bull market train
Yeah.
for the last 20 years. So what were you doing at the beginning of this long
Well,
road?
Dale, thank you for having me first.
Great to have
And
you.
yeah, it takes a special kind of breed to be a short seller or a bear. And when I started 10, 15 years ago, I think it fit my personality, so to speak. I'm not a cynical person 24 by 7, and I don't think that's good for business either. But I do like, I'm curious and I do like to find companies that are not supposed to be in the business or
Okay.
not supposed to be valued the way they are. And I think short sellers are a critical component to a well-functioning market. And we strongly believe that knowing what stocks not to pick makes you a better long investment trader than otherwise.
Yeah,
Right.
that doesn't show up on the P&L, the mistakes that you would have made by
Yeah.
being long something that loses 30, 40% because it's a meme stock.
Yeah.
Um, so, yeah, it's really important avoiding bad trades, almost as
Yeah.
important or more important than being in good trades.
Yes.
So,
Yes.
okay. All right. So, a lot of opaque things. So you say you don't speculate, you investigate, and you wanted to start with what is probably the most opaque thing out there is the private credit markets. And, how can you have good marks on something that's opaque and how they're valuing it? Is this really going to be one of the fuses for the next bear market in equities and a recession or financial crisis in the US?
I wanted to start off saying that it is I was talking to somebody this morning. Everybody was mentioning either, oh, this is going to be 2000s or 2008. And we don't think it's going to be like one shot, right? It's going to be persistent um,
Drawn
depression
out.
or persistent recession. And what we see is this time around, if you see different segment of the market, and private credit actually started in after 2008, 2009, because of all the regulations, um, businesses, small and medium businesses who were rejected or overlooked by regular traditional banks and consumers who don't have enough credit to reach out to the regular banks, neglected by regular traditional credit offering facilities. So private credit came in and took all of those together under their umbrella. So now going back, it's going to be um, lower K is suffering. We are seeing a
Right.
lot of consumers who used to be six figures is not even middle class these days. So we see all those consumers falling down into the affordability category, and you have the upper K going high and high. So we are seeing less spending, more reliability on private credit funded BNPLs, and lack of affordability in terms of basic needs. So we are seeing those kind of persistent deterioration, and that is going to be in a longer term. In other words, you won't have like one shot crash like 2000 or 2008. You're going to be having multiple mini crashes, and some comes from private credit, some will come from yen carry, reverse carry trade, and you will have the small pockets here and there will burst, and that will deteriorate faster than any one blow up in our
Okay.
point of view.
Okay. Could I suggest a new letter? It's a consonant as well. How about the letter L?
Flatlining, yeah, that works.
Yeah, no one's talking L yet, Lakshmi. So
No, not yet,
yeah,
not yet.
because everything's been a V, right? We have these little heart attacks, and the Fed goes to work, and the Fed has everyone's back, and you've gotten rich just buying every dip, every fear move, every move in the VIX over 40. If you bought the market and sold volatility, you've just cleaned up. What's going to be the trigger? You know, this has been going on with the consumer. I think we've been in K for a while. Um, isn't it going to take the upper part of the K to become pull their horns in because of perhaps their asset values of equities and real estate are under pressure, and that would really be the nail in the coffin?
Yes, and that is not going to be the only one. We are seeing all the prime consumers, um, you know,
Right.
shifting lower to Dollar Tree and Dollar General for shopping, or Target and Walmart. And we are also seeing defaults and delinquencies spiking up in auto lending.
Yes.
In sorry, auto loan delinquencies. We are seeing there are a lot of small mom and pop lenders in the auto sector that are permanently stopped originating loans. And they
Okay.
unanimously, we interviewed a subprime lender recently, and his company permanently paused um, originating auto loans because there is no demand. And consumers, and we are not tracking layoffs, but layoff numbers are growing. We expect a labor market to weaken further into 2026. And what's concerning is that you can measure something, Dale, that you can see. You can measure everything that goes into credit rating agencies and say, okay, auto loan delinquencies is X. So credit card delinquencies is X, and student loan delinquencies going through the roof. But what's concerning is the BNPL market. So private credit is, I have to check here, they have redefined. If you see private credit delinquency or defaults, you don't see much because that's their core selling point. We have low defaults is the private credit selling point. And
Hmm.
we looked into it deeper and we realized that they changed the definition of default. So it's not Chapter 11 or it's not a missed payment, right? So those things don't like, doesn't matter. If you're defaulting, similar to auto loan, you modify the loans to make sure it's current on the paper. The private credit, they exclude flipping cash interest into PIK, payment in kind, right? And they also exclude maturities that they are pushing out, right? And the rating agencies call this with a fancy name, is called selective default. So when you look at the defaults are fine. They are very low, so everything is fine. But if you look at selective defaults, I think they have skyrocketed over the past. Sorry, I have to check the numbers. So
And the market
selective
is,
default.
And the market is buying this definition shift, which
Yes,
all it is relabeling what a default to
yes,
a selective default, and they're
the
accepting it.
very selective
How how
default.
how, how do they manage the losses, even though they're not calling it a default? The losses are the same, right?
The losses are the same. It's in the paper. It's just you don't see it on the numbers. So if you don't see it on the numbers, you don't hear it in the headline news. If you don't hear it in the headline news, the market is not going to change.
Okay.
So
All right.
we are here. We started seeing this first in auto loans, and if you can question the companies like, we are not recommending Carvana as long or a short. And I almost have to say this as a disclosure in every single conversation because companies like Carvana or Ally or any regional banks with severe exposure to commercial real estates or auto loans or floor plan lendings, you don't see them going down as fast as they should because we are tracking the asset-backed securities, trust by trust, month by month for Carvana, for Ally, for everything. And what we realize is the number of modifications in a loan have drastically increased. So if you increase the modification, the amount your consumer is paying every month will be from $500 to $100, but the loan terms have increased. So they are still current on paper.
I see.
And if you ask me how long can it go, I'll give you an overview with respect to private credit, right? So the shadow banks have grown so much over the past 10 years. I would use the word private credit has infested consumer lending, so
Okay.
much so that commercial banks, regional banks are funding the private credit
I was
close
just
to
going to
a
bring that
trillion
up. So
dollars.
we don't even have a firewall between the commercial banks, which where most people keep their money, because they will take a hit as well because they came in to finance it because they couldn't do it to get a piece. And
Yes,
now they have
it,
exposure.
they have exposure, but here is the sad part that we know everybody has exposure, but we don't know how much. We know it's $1 trillion. We know $1 trillion being overall allocated to non-bank financial institutions, aka private credit shadow lenders. We know 750 billion of 1 trillion hasn't been touched yet, so they can still draw from it, but we don't know where the money is going, to whom it's going, how much of it are defaulted, what percentage of those loan allocated to BNPL or other agencies or non-performing loans. We have no idea. If anybody has any ideas, please feel free to email us, but we have no idea because it's opaque.
Right.
And that opaque nature should scare the investors.
Okay. So
And
there's an expression that confidence is only as good until people find out what the con is in confidence. So, what's going to take, like a gumshoe reporter, to finally dig in and we start seeing this on the media? And I pulled up the KRE, which are the regional banks, which
yeah,
this is a monthly chart.
yeah,
This was COVID, this big break, and then this was the SVB deal where the Fed came in and rescued. And we're
yeah.
almost at new all-time highs. So are you salivating for shorts in regional banks?
I will give you an answer to that in a different way. So, Washington Trust Bank last quarter earnings call was very, very interesting. The reason the reason I say that is during the conference call, they took a huge charge off, and an analyst asked a question. Hey, you appraised this commercial real estate property last year, and that appraisal amount doesn't match the amount of charge off that you took. So is the appraisal wrong? And the management almost said, I don't remember the verbatim, excuse me, but the management said, well, the appraisal is not always accurate. Now, the analysts push back and ask, okay, so does it mean that the appraisal of all the loans in your CRE book is not accurate? And he wasn't able to properly give an answer. And that tells me that no regional banks, I don't talk about big commercial banks because I blanket statement, we understand that they will be bailed out. But most regional banks and most banks in general have no idea what's in their books. They haven't marked to market yet. They have no idea. Unrealized losses are sitting in there and non-performing loans are there, and no one is properly reserved when things go south.
Where are the regulators?
I didn't even know we have one.
Okay.
I
Maybe
mean,
we don't.
Listen, there are so many things going on, and half of this I won't get into it because we don't try to flirt with politics, right?
Yeah.
But regulators have not been doing their job for a long time.
Okay.
And we don't, people are like, oh, are you a doomsayer?
Yeah.
No, we are just presenting the facts. We are not saying when the top is going to be. All we can say is, this is our primary research. This is what we are seeing. And we are going to see a drop here and a drop there. And these are all the empty pockets because, things can be crappy and things can still go all-time high.
Yeah. Yeah. I will
But
say this, though, as a technician, this Washington Trust Bancorp is a much weaker chart than the overall KRE, which is
yes,
pushing these old highs. This
and
one's,
we have
go
been
ahead.
recommending this as a short along with other 4 or 5 other regional banks because their technicals is crappy, and if you look at the books, they are even worse. And these are the banks no one can save. If I'm sure you were following the news of Fifth Third Bank and the
Yeah,
and Tricolor incident, and they
right.
turned around and they bought CMA, and now they are the top 10 biggest banks that are too big to fail.
Yeah.
So we are focusing and targeting on commercial real estate banks with high exposure to, regional banks with high exposure to commercial real estate, banks that has exposure to factoring receivables,
Okay.
banks that has exposure to floor plan lending and lining credit. We are not touching BNPL asset-backed securities because we are not able to track where everything is going. It's scattered.
Yeah.
And
So it's
it's
kind of like the way the people had trouble in the Big Short with all the derivatives. It was
yes,
pretty opaque. Because they were right, and the market was able to put pressure on them for quite some time before the market started going their way because of the instruments they were trading.
yes, but we have to look at things differently. And I say this to everyone who says, "Oh, it's like 2007, 2008." Maybe so, but 2007, 2008, after the fact, there was actual regulation,
Yeah,
right? There were
yeah,
checks and balances, some kind of accountability. Yes, no one went to jail, but there was some kind of accountability. But all these non-bank lenders, uh, shadow bankers, private credits, focusing on consumer lending, came after 2008. So
right.
they haven't gone through a cycle of boom and bust yet. So that's what concerns me. And, you have yen reverse carry trade, Japan, geopolitical issues, and you have trucking sector. We have been following trucking sector for a while, and the freight has had challenges over the past quarter, and consumers cannot afford. They're stacking on BNPL. Layoffs are increasing. So you have problems from all sides of the economy, not only domestic, but global.
Global.
And
Okay, and you think that one of the triggers, the main ones could be the unwind of the carry trade, which you say is not a trade, but it's a margin call on Japan. So here we have the yen. This was intervention, and they were successful, but there was a pretty good decline in August of 24. We went through an episode of an unwind. Um,
exactly.
but it was looked pretty well contained. This time, you don't think it's going to be contained because the interest rate picture has changed. Back then, they were still basically at zero rates, and what's happened to yields in the last 6 months is unprecedented for Japan.
Yes. And Michael Gayed has been the one who's tooting the horn on this for a long time. So to piggyback on him, the carry trade is basically, as you know, it's a global interest rate arbitrage that
Right.
starts in Japan. It's decades, like you said, it's zero interest, near zero interest rate. They're borrowing it in yen at very low cost, convert that into dollars and other currencies by high yielding treasuries, corporate bonds, ABS, they are everywhere. So this arbitrage works, as you know, as long as two conditions persist. Japanese rates stay low and the yen doesn't strengthen too much. So when that changes, the risk is in the reverse. If the Japanese rates rise or yen suddenly strengthens as it's been going back and forth, everything can change. And what we are tracking recently is, and we are going to publish that effective this Friday on our newsletter, is that how, which sector, which companies or banks, and how much are exposed to this yen reverse carry trade.
All
That's
of
what
them.
we are focusing on.
All of them.
Yeah.
Okay.
They are in
And
auto lending, they are in ABS, and no one has any clue how much they are. They usually give a range from this to this billion for CLOs and ABS. And so we are trying to approximately track this, and that would trigger cascading impact across other structural flaws that are fundamentally crappy, for the lack of better words, in the equities.
so the yen crosses might be the short of 2026, or just the outright short of US dollar yen.
Yes, unless someone has a magic wand and make everything disappear, then you can still kick the can down the road. But so far, it appears that's the case.
Okay, so we're not getting the Wizard of Oz for a new Fed chairman. Looks like it's going to be Hassett. Have you ever seen a country where the leadership of the country can basically dictate what the central bank does and have it be successful?
I respectfully try to stay away from politics because that helps us to be
Okay,
objective in being a researcher. And also, if you take a side, you always eliminate the other side. So,
okay,
yeah, sorry, I can't answer that question, unfortunately.
okay. So why don't we just maybe close it with the consumer weakness, private credit. We've covered the yen carry trade. Um, how much bigger is shadow banking than commercial banking, Lakshmi? Double the size?
What's that?
Double the size of
Double the
commercial?
size, yes. It's in trillions of dollars and it's very opaque.
Okay. So
And
go ahead.
sorry, go ahead.
No, go ahead.
So private credit, gives the option to the consumers who are deep subprime and who are somewhat prime. the ability to buy things, and we are consumer-driven economy, and
Right.
everything goes fine, and you have um, commercial banks, regional banks funding these private credit to fund the BNPLs and other um, sector that relies on private credit. But these things go as long as it can go because, like I mentioned, they redefined how they show the default. So what we need to focus on is selective default rate has been increasing, and that is concerning.
Okay. And since you know about this, I'm sure that Paul knows about this, and I think a lot of people do. So we're probably going to need someone in power to bring this to the market's attention. It's kind of like an avalanche. It snows and snows and snows, and nothing happens until that one last snowflake hits that snow pile and everything goes. What do you think is going to be the trigger for the recognition phase that this is happening?
The administration has to take steps that are short term uncomfortable, but long term benefits the market. The market, the AI is pretty much running the show. So we expect a huge write offs in all the data centers and other aspects of AI in different companies. So there will be a crack. There needs to be a crack in this AI show for
Okay.
everything to correct itself.
All right. So you got right to the heart, or should I say, brain of the issue, although it's
Yes.
artificial. And really was a pleasure talking to someone who has the intensity and is a watchman for people. They should definitely not carry huge deposits, even if they're not going to trade with some of these banks that you see as targets. Do you think that there'll be bail-ins, or do you believe that the Fed's just going to be able to bail every bank out again?
I don't think taxpayers are willing to bail every bank out, but the big banks will be bailed out.
By their depositors or by who?
The taxpayers.
Okay, which yeah, in a different way. I tell you what,
Yeah.
I really enjoyed. I'm so glad that Harris reached out to me, and um, I recommend people go check out your work. Do you work with institutions only, or retail traders, or wise guy kind of big shooters? Can they get your research?
Yes, they can. You can go to our website and click on the contact, and that will send us an email. And we also have a newsletter that is contrarianunicus.substack.com. And we cover the macro analysis over there as well.
Okay, well, I'm going to be keeping an eye on this because I believe that we're in the fourth turning, and what you're talking about, people have to be aware of because you talk about not a V. I think the letter L, because this could be a 10, 13-year ordeal once it gets going, right, Lakshmi?
Yes, and it's very concerning because the lower K or the L, the flatlining population,
Yeah.
are the ones who are going to feel the, lack of better words, wrath of what's coming. And that is very, very saddening to see.
And the 10%, if what you say happens and the market takes a 40, 50% hit and the real estate values drop in half, um, they may feel like the K people do now. Do you think?
Well,
Are they completely insulated? Because I mean, they feel the wealth from assets, and
we,
I can't see this not having an impact on inflated assets being deflated.
Dale, to be completely blunt, the lower K are suffering. They cannot afford the
Now,
basic needs,
right?
right? They cannot afford the basic needs. So now they are at a point, you have these people at a point where they have nothing to lose and they are angry.
Yeah,
So, there is going to be a social unrest, and we are
yeah,
seeing pockets of here and there, and there is going to be a lot of it because, you know, you take the affordability of basic needs of
yeah.
food, clothing, shelter, and the roof away from people and make it expensive. That's a problem. So I think the upper K, the 10% that you're saying, they have less to worry about their asset values falling and more to worry about how they're going to tackle the unrest from the lower K.
They're leaving. They're leaving Europe, aren't they? They're going to places like Dubai and so forth. I mean, a lot of them see the writing on the wall and they're seeking havens.
Yeah.
Where do you reside?
Somewhere in the boondocks in Connecticut, Richfield.
Okay. Okay, so basically be away from crowded urban centers.
Yes and no, because we are bordering Danbury and other areas.
Yeah,
So uh, Richfield is not like upper K. It's in the center. It's
yeah.
somewhere down, and it's where you have the blue collar and white collar mixed together.
Well, you know what? Here's my hope that some of the upper K people that can afford to speculate that they are positioned correctly so that they become part of the upper K. That's my hope for all the people that are listening to us right now, and at least not have massive losses by being in the wrong kind of paper. That's
Yeah.
my hope for 2026 for you and all your subscribers and all the people that listen to me and put up with me interrupting my guests too frequently.
No, not at all. And it's such a pleasure. And thank you so much for having me.
Okay, well, I have a feeling, just trader intuition, that we'll be talking again, Lakshmi. And
Likewise.
really recommend people go check this out because I didn't even know about you guys until Harris reached out. And I'm glad our paths have crossed.
Thank you
Thank
so
you,
much, Dale.
Lakshmi. All right. Okay, that's a wrap, everybody. So, you have to not only look at the blue sky narrative, you have to keep your mind open to the other case. Keep an open mind. It will keep your account open. And don't just count your pips, count your blessings. This will be out on YouTube within a minute or two. Adios. See you, Lakshmi.